Anybody wants a refund on 2020? I mean, think about it. The Australian bushfires in January that nobody remembers anymore, the coronavirus, the social and racial reckoning in the United States, double-digit unemployment. Where is this going to end? So there has to be some silver lining there. Maybe think about all the time you just spent with your family. Although for a lot of people that's probably not a silver lining. But I found one for you. In the next few minutes, I'll tell you how you can save $50,000 by refinancing your mortgage. Because the 30-year mortgage rate just fell below 3%, an all-time record. Welcome back to the channel. My name is Martin Zeman, and in the intro I promised to tell you how you can save $50,000 by refinancing your mortgage. But before we get in the actual example with live numbers and specifics, let's talk about what's happening right now. In March, when the US was hit by the coronavirus, the Fed cut the interest rates by 1.5%. And at the same time, investors moved a lot of assets from equities and from risky assets into safer assets like the US Treasury notes. And all of this is pushing the yields lower. And so the 30-year mortgage rate, which serves as a benchmark in the industry and of which most mortgages are priced, is also coming lower in sync. And so now we are actually below 3%, which is an all-time low in the 50 years that the records were kept. So for those that are considering refinancing their mortgages and saving money and taking advantage of this environment of low rates, let's talk about a few things that you should really pay attention to when you're thinking about refinancing. So the first thing is you should really do your homework and shop around. Don't just blindly go to the last lender that helped you arrange your last mortgage. These people obviously work on commissions. It's not their job to have your best interest at heart. So don't just blindly go wherever you were the last time and assume that they will get you the best rate and it's going to be the best deal for you. One elegant way to do this is to use somebody like Credible. Credible.com is an online platform that helps you compare different offers from different lenders. They are a broker, they're not a lender, but there's no fees for you that they actually get paid by the actual lenders that they refer you to. But the advantage of somebody like this is obviously it saves you time, energy, and frustration of dealing with multiple lenders at the same time. But a big advantage is that they only do a soft pull on your credit records. So normally when you go to a lender and ask for a mortgage rate and a mortgage offer, they will do a hard check on your credit scores, and that decreases your credit score. By using somebody like Credible, they only do a soft pull on your credit records, and you can stick with them for most of the actual refinancing process and only deal with the lender at the end. So it's a very simple online process that's fast and painless. In fact, now that we're on the subject of credit scores, it's hugely important that you understand that your credit score is one of the main elements that the lender considers when they're offering you a mortgage rate. And so understanding exactly what's in the report and fixing anything that may be wrong is hugely important. In fact, one simple trick that a lot of people do, for example, if they still have a student loan that's outstanding with a relatively small balance, they will pay it off so that the credit score improves before you go and try to refinance or try to get another loan for something else. So let's talk about the $50,000 that I mentioned in the introduction, and kind of let me show you on a real life example of a young couple that recently refinanced their mortgage, how you can really achieve substantial savings if you pay attention to the details and kind of are smart in this ultra low interest and mortgage rate environment. So this couple bought their home 3 years ago and borrowed $300,000 at 4.25% on a standard 30-year term. The total cost of the mortgage was $540,000, which is split between the $300,000 that they borrowed and $240,000 of the interest that is really tagged on over the 30-year term. And here you see how really hugely important it is to get the best deal and the lowest mortgage rate, because over the 30-year term of the mortgage, this really adds up and the compounding effect really works against you. Now, 3 years later, they just refinanced at 3.25%, which is a full 1 percentage point lower. And so let me show you how that 1% difference really translates into big savings over time. Over the last 3 years, they were paying their mortgage as normal at $1,500 per month. And so those 36 months times $1,500 comes to $54,000 of what they already spent paying off their initial mortgage. Now the new mortgage is for $290,000 in principal, and it's only for 25 years. So remember, initially they had 30-year term, they spent 3 years paying it, so they would be at 27 left. Now the new mortgage is at 25 years, so they're saving themselves those 2 years of payments already. And they're doing it on a slightly smaller amount. But you see, given that they already spent $54,000 repaying the initial mortgage, only $10,000 out of those 54 really went towards the principal. So you see how the lenders make their money by front-loading all the mortgage repayments that you're paying them, and the largest portion of it is the interest. That's how they make money, because they don't really know that you will stick with them for 30 years, right? They expect that you will refinance at some point, so they want to make the money up front. Now the new total mortgage amount is $430,000. So let's look at the savings. Initially, they were expecting to pay $540,000. They already spent $54,000 repaying for 3 years. And the cost of the new mortgage is $430,000. So that's a saving of $56,000 just by doing this simple trick of refinancing and taking advantage of the new environment. Now, granted, this will be different for everybody depending on their FICO scores, on their personal circumstances. Obviously, this is a $300,000 specific amount that kind of works to around $50,000 saving. But most people that took their mortgages out in the last 3, 4, 5, 10 years were likely doing this at a higher rate than they have right now. So I think this is something that you should really pay attention to and focus on and try to refinance if you can right now. Let's talk about a few things that you really have to pay attention to when you're closing a new mortgage, the things that kind of get neglected in the whole process. One of the first things you have to realize right now, especially given the high unemployment and the coronavirus mess, any lender will take extra care to verify your employment. And they want to make sure that your situation is stable, that you're still getting paid, that you're still employed where you claim to be employed. So you'll have to get a verification from your employer. And so especially if you work in an industry or if you're in a situation personally where you think that there is a small potential that you might lose your job or be furloughed later this year, unfortunately, industries like airlines, for example, but many other companies, this is something you should pay attention to right now, because if you can refinance at this much lower rate that we have right now, below 3% or around there, and you may be out of employment later this year, it may become a lot more difficult to get a new mortgage. So employment verification and the documentation that you will need to gather and present right now is going to be scrutinized a little bit more than it used to be. Now, the second point is the fees. A lot of people get hung up on the interest rate that they're getting or the mortgage rate they're getting, but they kind of neglect all the fees that are tagged onto the actual mortgage. And so it's very important that you understand every single fee that is being tagged on. And don't be shy and don't hesitate to ask about all these fees and understand fully what they exactly mean. Which leads me to the break-even point of the mortgage. Now, the break-even point is where the cost of arranging the new mortgage, the refinancing, equals the savings. So let me give you an example. My brother refinanced his mortgage a couple months ago, and his refinancing costs were below $1,500. But as an example, let's take a refinancing cost of $2,400. And let's say that you achieve a saving of $100 on your monthly payments. So it will take you 24 months, $2,400 divided by $100 of monthly saving. It will take you 24 months of paying your mortgage just to achieve a break-even on how much you spent arranging this new mortgage. So that break-even point is important, especially if you're not sure that you will stay living in the current house for a long term. If you consider potentially selling your house in the next 2, 3, 4, maybe 5 years, it's really important to understand the cost of arranging the new mortgage and the fees that you're paying to get that new mortgage versus what you're actually saving, and how long it will take you to offset the cost of arranging that new mortgage. So all these fees are important when you're choosing your lender and understanding what they are, because they get bulked in the actual total cost of the mortgage, and a lot of people don't really focus on them. Now, finally, the PMI. The PMI is the private mortgage insurance, and it's a fee that the lender will tag on if you're putting down less than 20% of the value of the home. Now, typically, this is not a very high fee. It ranges somewhere from $15 to $70, $80. Let's assume it's $100. $100 a month is going to be $1,200 a year. So that PMI also is eating away at the advantages that you're and the savings that you're achieving by getting that new mortgage. So pay attention to the PMI, and as soon as you pass that threshold of 20% of equity in your home, you need to get rid of that PMI. Okay, that's it for today. This was my silver lining for the summer 2020. Thanks for listening, and I'll see you in the next video.